Welcome to Illuminati Silver. We tell you the truth about silver. Today is Friday the 11th of September 2020, and we offer our respects to all US citizens who will no doubt be thinking on this day about the horrendous attack on the Twin Towers back in 2001. Who can believe that this was as long ago as 19 years? With that in mind, in today's video we're going to talk briefly about surprising positive figures announced regarding the UK economy and a major trade deal that the UK has agreed with Japan. Now these are particularly relevant as the recent controversy between the UK and the EU over its eventual withdrawal, potentially ending up with a no-deal removal Brexit, has damaged sterling in recent days and causing both gold and silver prices to rise in sterling terms this week. Such has been sterling's drop, whilst gold so far this week is up $12, in sterling terms it's up £76. And silver, whilst down 7 cents so far this week, is actually up 73 pence in sterling terms. This is the result of sterling falling from $1.34 on the 1st of September to its current $1.28. And this is against a backdrop of the dollar index itself actually falling against a basket of other currencies. So hopefully some positive economic figures and a trade deal agreed with Japan, and more hopefully to follow, could reflect in sterling beginning to strengthen again, though as we will see from the article, that is far from decided as yet. So let's take a look at what Bloomberg has stated this morning about the UK's economic figures together with the trade deal, and we shall comment a little further after looking at these two articles back to back. Bloomberg article dated September 11th, 2020 at 8:02 a.m. GMT+1. Headline: UK economy surges in July, but clouds gather over Brexit. Britain recorded strong economic growth in July as coronavirus restrictions eased, but mounting job losses and the risk of a messy Brexit are threatening a turbulent end to the year. Gross domestic product rose 6.6% from June, when it gained a record 8.7%. with activity being boosted by the reopening of restaurants and bars in early July. However, the country has clawed back little more than half of the output lost during the lockdown, and recovering the rest may prove difficult. While Chancellor of the Exchequer, Rishi Sunak, said the rebound is welcome, the UK is facing a triple hit that could force policymakers to increase monetary and fiscal support for the economy. Cases of the virus are rising. The government's plan to end its furlough programme could cause a jump in unemployment, and a disruptive split from the European Union hangs over the outlook. All sectors grew strongly in July, led by construction, the Office for National Statistics said Friday. But output is still 11.7% lower than it was in February, and analysts warn a return to pre-pandemic levels may be a long way off. Risks include mass job losses as government wage support is withdrawn, renewed curbs to tackle a recent spike in COVID-19 infections, and the end of the Brexit transition period. Firms will see the imposition of tariffs, quotas and custom checks unless Britain and the EU strike a deal before the end of the year. The GDP figures come in a week that saw the prospect of an agreement recede dramatically after Prime Minister Boris Johnson threatened to break international law and rewrite the divorce deal he struck last year. That has sent the pound lower in recent days. Even with a managed exit from the Brexit transition agreement, it is unlikely that the lost output would be recovered before the end of next year, said Dean Turner, an economist at UBS Global Wealth Management. The latest twist in negotiations raises the prospect that any recovery may take longer. The The threats are piling pressure on officials in the United Kingdom to do more to shore up the economy. The Bank of England, which has expanded its asset buying programme and cut interest rates to near zero, has declared it has plenty of room to add monetary stimulus, even including negative rates if needed. Sunak, meanwhile, is facing calls to extend wage support for workers in the hardest hit sectors. The fear is that well over 1 million people could lose their jobs if the programme ends in October, as the government currently proposes. The impact could derail the economy's revival from its 22% contraction in the first half, the deepest slump among major advanced economies. Recent activity reflects pent-up demand and government stimulus, such as a temporary tax cut on home buying and subsidies for eating out, and high-frequency data suggest the momentum continued into August and September. Such spending has pushed government debt above £2 trillion, the equivalent of $2.6 trillion for the first time. That's affordable for now because of ultra-low borrowing costs. But Sunak has warned of difficult decisions ahead, a hint that tax rises will be introduced once the economic crisis has abated. Education grew strongly in July as some children returned to school, and pubs, campsites and hairdressers all saw notable improvements, the ONS said. Manufacturing rose across the board, with distillers and car makers posting particularly strong gains, and house building continued to recover. Bloomberg article dated September 11th, 2020, 9:30 a.m. GMT +1. Headline: UK agrees post-Brexit trade deal with Japan, boosting Johnson. The UK secured a free trade agreement with Japan, its first major post-Brexit accord, and a boost to Prime Minister Boris Johnson as negotiations deteriorate with the European Union. The deal, which is expected to boost Britain's GDP by 0.07% compared to 2018 levels over the next 15 years, was agreed in principle by International Trade Secretary Liz Truss and Japanese Foreign Minister Toshimitsu Motegi on Friday, the British government said in a statement. Striking an accord with the world's third largest economy has been a priority for Johnson, who is eager to demonstrate the ability to sign trade deals as an independent country, a key plank of the Brexit campaign he led. The UK benefited from the EU-Japan free trade agreement and needed a deal to avoid tariffs on commerce with Japan at the end of the year. Its timing is also useful to Johnson. Trade talks with the EU, Britain's largest trading partner, have deteriorated sharply this week amid a UK plan to break international law over the Brexit divorce treaty. That move has soured negotiations and increased the prospect of no trade deal being reached by December the 31st, when Britain exits post-Brexit transition agreements. The UK said 99% of exports to Japan will be tariff-free under the deal, which will add £15.2 billion to annual trade with the Asian nation. It marks an important step towards joining the comprehensive and progressive agreement for Trans-Pacific Partnership, the government said. Truss said the accord with Japan, negotiated in record time and in challenging circumstances, goes further than the deal it has with the EU, citing data flows and better market access for financial services. It secures new wins for British businesses in our great manufacturing, food and drink and tech industries, she said in a statement. This is a historic moment for the United Kingdom. Motegi said the agreement would allow British and Japanese companies to maintain business continuity after Brexit and provide greater opportunities for investment. It was a very difficult negotiation, but we were able to come to an agreement in principle in 3 months, an exceptional pace, he said. By agreeing on higher level, more progressive rules than the Japan-EU trade deal on issues such as electronic commerce, we hope that trade and investment between Japan and the UK will increase further. Okay, so whilst the economic figures look promising, this is far from definitive. And also there appears to be severe warnings here that more stimulus is likely to be required. Now, the jury is out as to how much extra stimulus will have to be pumped into the economy. But for sure, the COVID-19 pandemic is without doubt the key determinant of this. With regard to precious metal prices such as gold and silver, at least in sterling terms, unless there is a significant rise in the dollar value of these precious metals, we could potentially see gold and silver prices fall back a little as sterling attempts to readdress the balance with the US dollar. Now, longer term, this won't matter, as we're confident, of course, that they are strong investment propositions looking ahead. But day traders and speculators will need to look at the dollar-sterling relationship quite closely and make their decisions accordingly. Meanwhile, of course, the United States has its own issues ahead, which can cause some market disturbances, not least of which being the uncertain outcome of the US elections on the 3rd of November, and any issues which may arise in the run-up to those elections. We are already seeing equity markets being hit, though for the moment they're appearing to recover again. The failure of Congress and the Senate to pass an additional stimulus bill will have some notable effects on the economy, and potentially on the dollar value too, which we're watching very closely indeed. Meanwhile, do share your thoughts with us on this matter, and as we produced yesterday's video a little late in the day, we draw your attention to it and leave a link in the description box below, and it's entitled Gold and Silver Rise and Fall as ECB Leaves Rates Unchanged, where we're addressing more about the European Union and what difficulties it has been and will continue to experience. Thank you so much for listening. If you haven't already done so, please subscribe to this channel and press the bell sign so that you're notified of our videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.